everyone, welcome back to the channel. Today we're going to take a look at Alibaba. It's been about 2.5 years since I've last looked at them. The last time I looked, they were coming off a 40% year-over-year increase in revenues. This gave us a valuation back then between $250 billion and $700 billion, largely depending on what discount rate you were to use. At that point in time, Alibaba was trading around a valuation of $280 billion. So actually very close to the low end range of my valuation analysis. As of today, I get a valuation between $200 billion and $375 billion for Alibaba. Today, they trade at a market cap of $190 billion. So once again, they are trading at the low end of my valuation range. Now, I'll walk through my updated model and some key things to note, as this model is a bit different than most of our normal models that I do on this channel. If you're new around here, I wanted to quickly point out that you can follow along to any of my valuation videos. All you need to do is scroll down to the description and there will be a link for the model. You will need to make a copy of this model, but that will then grant you edit access so you can follow along and adjust my assumptions as needed. Now let's hop right into it. First, since I made my last model in 2021, one main thing has happened. Revenue growth has stalled out. In 2022, they grew 19%, which is actually what I projected back in 2021. However, in 2023, they grew revenue by just 2% for the full year. In my previous model, I had them maintaining a strong growth profile for the next decade. In my updated model, I've actually reversed this. And I have them growing at a very steady, low growth rate that keeps pace with inflation around 3 to 5% annually. On my income statement tab, I actually break out the growth projections by business line. If you take a look, you can see I have some of their units growing 15%, then tapering off while others have been low and remain low. The biggest driver here is the China Commerce Retail Business Unit. It declined last year, and based on news hearing that the Chinese consumer is slowing spending, I don't see this reversing quickly. I have it recovering slowly to a normalized 3% growth in the future. The reason this item is such a big piece is this makes up over 50% of their revenues, so it can dictate a lot of the overall revenue growth for Alibaba. If you think Chinese consumer spending will pick up very quick and go back to a high growth economy, adjust this line item in the model. Next, I've made slight improvements to COGS to align closer to their historicals in 2022, around 55%. Sales and marketing, I've left in line with historical levels, around 12%. General and administrative, I've also left in line with historicals around 5% of revenue. With all of this, we get revenues going from 868 billion yuan to 1.2 trillion yuan in a decade. So about a 50% increase in total revenues. At the same time, free cash flow goes from 121 billion yuan to 200 billion yuan, almost doubling in a decade. Now a quick note here, these numbers are reported in Chinese yuan. I only convert to USD when I calculate my final valuation. The reason for this is over time, the exchange rate changes. So if I put the income statement in USD at today's rate, it would adjust by the next time I open up my model and I would have to recalculate everything. So now let's move on to the final valuation based on these assumptions. I get a valuation between 200 billion USD and 375 billion USD. The main thing to call out here is the discount rate. At a 20% discount, we get a valuation of 200 billion USD. They currently trade around 180 billion. If we use a 10% discount rate, we get a valuation between 360 and 375 billion. So what does this mean and what should we be using? That is really the million-dollar question with Alibaba. How risky do you believe China is? For reference, the S&P 500 has returned historically around 11% annually, not adjusted for inflation. That's why I usually actually use a 10% discount rate. If you think Alibaba and the risk related to China is about equal to that of the US-based company, then there is about 100% margin of safety. The company is trading at half of its intrinsic value when we use a 10% discount rate. If you think Alibaba is about 50% more risky than a US company because they're being operated out of China, then the valuation is about 250 billion at a 15% WACC with a margin of safety around 40%. And if you think that operating in China is twice as risky as a US-based company, then use the 20% discount rate, and their intrinsic value is roughly where they're trading now. Aswath Damodaran recently published his market risk premium update where he calculates the risk premium for equities for each country. And for China, he actually calculates a risk premium of 4.89%. which is slightly higher than the US risk premium he calculates of 4.12%. This would imply, based off his model, China is only slightly riskier than the US. He does have a very academic view, which makes sense as he is a professor. He leverages the default spread based on Moody's country ratings to calculate a country's risk premium. I'll link below actually his article where he walks through his analysis. So if you believe there's no more risk in China than the US, then you could conclude Alibaba is very undervalued currently. And recently, Michael Berry, behind Scion Capital and famous for his portrayal in The Big Short, has reallocated funds to be largely in Chinese tech firms such as Alibaba and JD.com. So another positive sign that maybe China isn't as risky as maybe believed. I, however, personally believe Alibaba is undervalued, and I would personally use around a 15% discount rate, getting me a $275 billion valuation. However, I don't think the rest of Wall Street agrees with that sentiment. I believe for Alibaba to have an accurate valuation, something would need to happen in the larger global realm around general relations between the United States and China. There needs to be a larger geopolitical environment with less global tension, in my opinion, for Alibaba to slowly grow into their intrinsic value. Anyways, there's my thoughts. I think they are undervalued by every performance metric that you could calculate, but I think the broader global political climate is not going to allow them to grow into their intrinsic valuation. If you have a positive longer-term outlook on world conflicts, then I say they are most definitely a buy at this time. Let me know your thoughts below, and as always, thanks so much for watching.